Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of The Options Playbook, and I'll be your host for about the next 30 minutes here on Options Guide TV. It will be a little bit longer show because we do have a lot to talk about. Today is Friday, February 2nd. We had a Fed meeting this week on Wednesday, and gosh, I don't know what to say all about it except for the fact that they really Tate. They really. I guess the biggest thing that came out of the meeting is they did not raise rates. They did not lower rates. But if you look at the Fed fund futures, they really took away the possibility of lowering rates in March. So we now have 47 days until the next Fed funds meeting. And right now I'm showing you the CME Fed Watch tools over at CME Group. And if you scroll down, it will show you the next meeting is now in March. And the probabilities of a rate cut have been all over the place. So I'm going to highlight the bottom half of the screen. So 1 month ago on the March futures, there was a 69% chance that they were going to cut interest rates by 1/4 point. Then 1 week ago, it went down to about a 46% chance. And then on Wednesday, now we're all the way down to a 19% chance. So very interesting how people interpreted what Jay Powell said in the press conference. And obviously, they're thinking now that we're going to go all the way out to either May. So May has moved a little bit too. So let me click on the May Fed funds futures. So here is the current rate is 525-550. And they're saying a 56% chance in May that they're going to lower it 1/4 point. And there's an 11% chance that they might go 1/2 point. I think that would be kind of crazy. That's a little bit out there. But then if we go into June, we have basically the same numbers. Right here is the current rate is here. There is a 34% chance in June right now. And then that is going to go to 500 or 1/4 point cut, and then a 50% chance that they actually do a 50 basis point cut. So with that mentioned, but June's a little too forward looking. Obviously, what happens in May will affect June a lot. The chance of a 50 basis point cut is very minimal if they do something in May. But the markets are reacting positively. So if you go, and I think we'll jump back out. Let's go to the TradeHawk software now. And we'll pull that up and we'll talk a little bit about what's going on in the markets. So in the SPX right now, we're bumping up against all-time highs. 49.37 is a line in the sand. This could be a potential breakout. It'd be nice if we finish above this level at the end of the day. We're up 31 points or a little more than 0.5%. And that range, we've been dancing around the 49.33 level in the chart. Definitely a line in the sand. If we can break through and establish a new high and move on, that's obviously going to be really good for the markets. And our little stock, these are the earnings that we looked at today. Or that we looked at this week, I'm sorry. But we had AMD. AMD actually is back in the fold. We did on Tuesday, they announced earnings, and we put together a long call spread that we did on Monday. We usually would do it on Tuesday, but we don't have a show on Tuesday, so we did it on Monday. And the market has came back, and now it's within the strikes. We did the 172.50 and the 177.50. Initially, the stock was down on the earnings, and now we see it back up again, 174.73. We looked at Apple. We talked about a protective put spread in Apple. It didn't really help us out much. The stock is down 1. It was down more earlier, but and I would have if you had some value in it after the news event, I would have definitely gotten out on the open because we were doing we had 1 week for the Apple trade to play out. So we went a little bit longer than what we did in Amazon, which Amazon is up quite a bit today too. Amazon is up 6.5%, up 11.43. Meta is going crazy after they announced earnings. That is up 82 points or 17% on the underlying stock. Netflix down a little bit, Microsoft up from the beginning of the week, Google down a little bit. So a little bit mixed on the mega cap tech stocks, but let's review the trades that we looked at on paper, or one of them was speculative in Amazon. The other one was a protection play in Apple by using a long put spread. And then we'll set up our SPX trade because last Friday we did an out of the money skip strike butterfly. It's not going to quite get to where the market is at, but we will actually take a quick peek at that. Let me send this one to the what if calculator. And we'll take a peek at that trade, which this is that trade that we put on. AMD, that's our long vertical that we did. Let's put this one up. Let's go and throw that into the calculator. If I can get my screens to move. And there they go. All right, send the ticket. So right now, when we did the AMD trade, which we did say we had some time left on this, we paid $2.20 for this long spread that expired that's expiring today, this Friday. 172.50, 177.50. We paid $2.20 for it, and it's now trading for $2.46. So if you stayed the course and just let it play out, you're doing fine. And it just came into the money this morning on the movement in AMD. We're up 2.6% or up $4.57 on the day. So you could get out right now at a small profit. If you wanted to ride it, then take the momentum of the market and whatever Meta is doing with the marketplace, feel free. It's really your call if you would get out on it right now or if you would actually trade it. The fact that it came back into the money and you're actually profitable on the trade, well, thumbs up. So if you want to stick around and see if we can get it up to the 177.50 range, all right, feel free to do it. Now, in the SPX, February 2nd expiration here. Let's go put this one in. On this trade, we went out and the start of our SPX trade, let me grab this right here. The start of our SPX trades was 49.80. 49.80. Okay. So we're right here. So this is the first option in our skip strike butterfly. Then we went, and this is the February 2nd expiration. Then we went 10 points up and sold 2 of the 49.90s and skipped the 5,000 and then went to 5,010 and bought that one. So right now you have a net debit of 10 cents to the account. That means that if you took the trade off, which I wouldn't do, we would just let it all expire worthless. It would cost you 10 cents to take that trade off. Oh, actually, to put it on, we'd actually we might actually get a dime on this trade if we wanted to, but we're right around the midpoint. All I would do is just let it ride, because if it did move up to 49.80 for some reason, we got a strong up move today, in that we're bumping up against all-time highs, and this is part of the reason why we put this trade together, and this is why we're going to put another trade on, is that if we don't, the market's going to struggle to get to all-time highs. When we put this on, we did it for a net credit of 80 cents. That meant that we had a $1,000 requirement. We brought in $80 for every 1x2x1 skip strike butterfly that we put on. And we're hoping that the market could get up towards the 49.80 level and finish somewhere in this range between this strike and 5,000. We're right in that range, and the market didn't do it. So we made 80 cents. Oh well, we made $80 on our $1,000 requirement. Not a bad week's work, without any real risk in that trade. In other words, we never really moved and made this trade unprofitable at any point in time when we put it on. Because when you initially put on the skip strike butterfly, you have risk if the market actually moves strong towards your middle strike. Unlike a normal butterfly, this trade wants it to slowly move up that way. And that's basically what's happening in the SPX. We're going to put another one of these on, and that's going to be the start of our week for Options Guide TV next week. All right, now Apple. So in Apple, we talked about the fact that most people and at a lot of brokerage firms that I worked at, if they had a stock portfolio, almost all of those retail clients had Apple in it in some way, shape, or form. A lot of them own the shares outright. By far, the most heavily traded stock is Apple. Just over time, I should say. It's not necessarily like Nvidia is now obviously a very popular stock. The stock is going to the moon at this point in time. Somebody's trying to lasso it and make it slow down a little bit, but it just keeps going. And if on Apple, though, almost either in an SPX fund, in any other type of fund, almost everybody owns some Apple. So we talked about if you have 100 shares of Apple and you were nervous about the earnings report, and let's pull up the chart real quick and see where Apple, where we hit. Yeah, we hit down as low as 179.33. It looks like that was the low on the day. And we did a 180, 175 long put spread. So if you wanted to trade out of that, that would have been profitable on the protection. We did that entire trade for $1. So if you could have sold it for $2, you could have got out of it. If you were not as nervous about the earnings, it lasted a week. That trade was fine. That was on the open that it actually came down and hit that area. We could probably do, I'll just leave it there. We could do a 15-minute chart, but I'm going to leave it right where it's at. So you can stay long. Right now, it's all the way back, 186. And so it's flat on the day, but it did stay down for quite a bit. But look at this little area of support that we had too, right down in this range, right around the 200-day moving average. This was a little bit scary right here when we broke through that 200-day moving average. Let's add some days here. And we'll pull this up. So this breakdown right here was a little scary on the open, but it obviously hit this area right in here, right around 180. It looks like there's a little level of support on the chart here, and we did get the bounce back up, and now we're back up to even on that trade. The other one is Amazon. So in Amazon, we tried to put a skip strike butterfly together on that trade. Zoom in here. And we couldn't well, we looked at it and it was done for a very small net credit. So I decided that I didn't want to add the risk onto the trade, and I didn't want to go only, I think we had to go all the way down to 2.5 point strikes in order to get it done for a decent net credit. So because of the dynamics of Amazon and the fact that it's a little bit lesser price stock than we have in the SPX or Netflix, which we did last week, a skip strike butterfly in. So because of that, we just did a long butterfly, and that was the official speculative paper trade for the week. And we didn't quite get there. We're at 170. Yesterday we closed right around here, right around 160 or so on the underlying stock. We're now at 170, up about $10 on the day. Actually up 1166 on the day. And here's the trade that we did. A one-day butterfly in Amazon. So Amazon, we had the 170, 175, 180. So let's see where we're trading, where we're landed. So if the market keeps going up, we're going to look fairly decent. 171, that's not bad. Close this out. February 2nd, let's buy this, sell 2 of those, and buy one of these on the ask. So we're at 137. So we put this trade on for 33 cents. And once again, we did it on Wednesday. Normally, you would wait until Thursday. They announced earnings after the close on Thursday, but you would set up the butterfly using the same type of concepts that we talked about, looking at a 1 standard deviation move, trying to you decide if you're going to be bullish or bearish on that trade. And we risked 33 cents and we're up $1 on that. So we've tripled our money on that trade. Decide if you want to get out or you let it ride today. I wouldn't mind just getting out of the trade at this point in time. You got enough of a winner to get out. If it gets up to $2, I would definitely get out. Obviously, I don't want to hang around and just hope that it lands right at 175. If you do that, well, good luck with that one, right? If I had a bigger position on, like even if I had 2 butterflies, 2 1x2x1 butterfly units on, is a way to say it. I might get out of one of them, just get out of one and let the other one ride a little bit. Make sure that I'm going to be profitable on the speculative trade, but this trade worked out excellent. This is exactly how you'd like it to happen. Run up, land right on the 170 mark, and then slowly start moving towards the 175, which gives you the opportunity to trade out of it. But it's 170.83. It's trading for 129. I would probably, on my 1 lot butterfly, just get out right now, not hang around till the end of the day. Take that profit and run. All right, so not bad trades this week. AMD was looking a little scary, and now it's back in the fold. As a matter of fact, it's even up a little more now. 175.50. We're up $5 on the day, $2.75. So every single cent that AMD moves today is going to affect the long call spread. They max out closer to the expiration date. So our long call was 172.50. And so if it hangs there, we did talk about closing it out on Wednesday, or you could stay the course. I would have stayed the course in that we limited our risk by doing the spread to $2.20. Let it ride until the Friday expiration. But we did look at how much we could salvage if we stayed into it. We actually looked at doing a butterfly and bringing in a small dollar amount if you considered hedging it by rolling it into a butterfly. And that actually would have worked out pretty good today too at this point in time by looking at where the stock is at. All right. So if you want to see the hedge trade, or the adjustment is a better word, to our AMD trade, to our long call butterfly or our long call spread in AMD, go back and review the show on Wednesday's show. All right. So now, if you have any questions about any of these trades, we had a lot going on, and we got a lot going on next week. This was the week for earnings and mega cap tech stocks. All the Meg 7 stocks are announcing. We still got a big one. One of the last ones to announce is NVIDIA, and that is all the way out on the 21st of February. So we got some time before we get through all of these, but NVIDIA is the last of the Meg 7 to announce, and we'll do something prior to that. As usual, we're just trying to learn here on Options Guy TV. So looking at speculative trades around earnings isn't a staple of the portfolio, but you learn a lot about option trading when you look at the way these things are priced and how the underlying stock moves. Now, the one trade that I would keep in my portfolio, especially where the markets are at right now, is my SPX trade. Looking at a skip strike butterfly in the SPX, we have the underlying market at 49.40, 4,940. up $31 on the day. So if we're going to set up a skip strike butterfly, we want to go out to the Friday expiration, which would be February 9th. And we set one up last Friday. It looks like it's going to go out worthless. We're going to make our $80 on our $1,000 requirement that we had on the trade. And we're going to do something similar this week too. See if we can get the breakout and get the move up. I think the 5,000 area is going to be kind of tough for that underlying market to break through. And that actually is now that we're looking at the delta. There's a 21% chance based off of the option prices that the stock can break above and finish 1 cent above the 5,000 level by the next Friday expiration, based off of what Delta is telling us. So this area is what we targeted before. But the market our risk is that we get the huge move all the way up. And we talked a lot last Friday about the fact that we're really selling a short spread to pay for a butterfly. That's what a skip strike butterfly is. And actually, no, I think we'll just do it. I'll show you it in the what if graph. I was going to go to the options playbook, but I think we're going to leave it there. So I kind of want to straddle the 5,000 area, but I think I'm going to lay down until the urge goes away on that. And I'm going to do at least a 1 standard deviation move out. That's the standard that we would. This big round number around 5,000, though, is really hard for the market to get through. Usually, it will usually bounce up against that a few times. So, yeah, maybe we do the same one. Let's do the same one. We're doing it on paper anyways. Let's do the same trade. If we were putting it on in a live portfolio, it might move out a little more, but I really like this range and the market maybe getting to this level. If we do break out today, it's going to be very big to see if we finish above where we're at right now. Actually, let's get the markets. So right now in the SPX, we are at 49.38. 49.33 is a very important level. We're looking at all-time highs. If we can break through that and stay above that today, that's a good sign going into Monday. All right, so let's do the same trade we did last week. Let's stick at 49.90. I had it all set up in a what if calculator, but we're going to change this up. So we're going to buy the 49.90. We're going to sell 2 of the 5,000s. And then we're going to skip the 50-10, and we're going to do the 50-20, and we'll buy one of those. And not bad. We're getting a much bigger net credit. Last week on Friday, we did it. We went 1 standard deviation out of the money. And because we went further out of the money than we are this week, we were able to get it done for a smaller net credit of 80 cents. So here, now we can get it done for about 120. I'm going to call it 120 right now. Let's leave it right there. And this will be our paper trade for the week. So until we establish new highs in the marketplace and we break out to the upside where, I guess where the chart would make us feel nervous about breaking all the way out to the 520 level where all our risk is at, I'm going to continue to do this trade. So if we keep hanging around the 49.35 level and we don't get that official breakout, I'll just keep bringing in that premium, bringing in $1.20 with $1,000 worth of risk as far as our skip strike butterfly is concerned. Just rinse and repeat and do it every Friday if we need to. Until we start getting up closer to this level, and then we will adjust the trade and we'll look at something different, depending on if we're bullish or bearish on the market at that point in time. So here's the official paper trade for the week. 49.90, 5,000, 50.20. All right. And it looks like we have a question. Let's try to answer that one. So let's put that up. Okay. I have changed it to a butterfly. Oh, you did. All right. So in AMD, we talked about the trade and moving it to the butterfly. And you could. So for a 40 today, I sold the combo for 1,228. So overall profit of 42 cents. Okay. Can you share what is actually a reasonable target? That's a reasonable target. When you have the butterfly on, so it looks like we'll just use the initials JV. JV came in and looked at the AMD trade, which was a long call spread. And on Wednesday, we talked about adjusting it. There wasn't a big net credit when we looked at it on the show, but JV did the adjustment and changed the long call spread into a butterfly, took a little bit of the risk off the table. Now the underlying market has came back, and the center strike then on the butterfly would have been the 177.50. So at 177.50 is where you'd want, that is the right one. 177.50 would have been the center strike. The market has came back. It's above our long call, which is the 172.50, and it's now trading within the range. And the question is, can I get out? Should I get out? What's going to happen with this trade? And here's where we're at. Because it is Friday, you have a lot of flexibility. If this would have happened yesterday, I would have thought about just getting out right now. If you got a 42-cent overall profit, I would consider just getting out of the trade yesterday, because you had one more day of trading. You have a lot of time value still on the Thursday options. Now you're on Friday. So all the time premium has to come out of our short options at the 177.50 strike. So it's going to be a very volatile butterfly, in that if the market keeps going on up, every dime and quarter that it moves, that cost of that butterfly is going to move. Because if you're correct on your forecast on the butterfly, the best thing that can happen is that your two short options decay at a very rapid pace. And that's what's happening right now. So 47 cents is a decent profit for sure. If you want to get out at this point in time, but if you do stay in, the price of that butterfly is going to move very quickly up or down. But I'd be more than happy with the 42-cent profit. That's the concept of rolling into that butterfly in general, is that I don't want the cheese anymore. Just let me out of the trap. I'm going to take a little bit of risk off the table by bringing in a small net credit to roll into the butterfly. And, best case scenario has happened. Best case scenario is that you finish right at 177.50, but good luck with that one. But with that said, right now is a great time to get out. All right. That's it for questions, and we're 1 minute over. So thanks for coming. Another week of Options Guide TV is in the books. Next week will be just as exciting. We'll look at a lot more speculative trades around earnings, and we'll see you Monday at 11 a.m. Eastern time for the next edition of Options Guide TV. Thanks for coming, everyone.